Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Nam Phan of Pacific Private Money. Mark Hanf is off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And we will have a special trivia question where the winner will receive a $25 restaurant.com coupon that can be used at hundreds of restaurants. Today's trivia theme is James Bond theme songs. I figured that's a good guy's trivia thing. Now, today we actually have 2 special guests, Dane Moeller and Kerry Ettinger of Primary Residential Mortgage. Welcome, gentlemen, to The Best of Investing.
Thank you.
Much, Edward.
All right. So, guys, we just got finished, I guess, installing a new El Presidente, and wanted to find out from your guys' expert opinion how that's going to affect mortgages, real estate, the economy. I know you guys are not economists, but you have your finger on the pulse with mortgages.
Well, that is, a big part of our job. And, the new presidency is going to be a pretty big change. But I think the biggest change here is the takeover of the Senate, or at least majority of the Senate by the Democrats to go along with that new presidency. Because now we got a team of unified party that's going to be able to really push some stimulus out there and get things done, which is great from a political aspect, but going to potentially have some negative aspects for mortgages.
So let me ask you, what do you think it'll do to, let's say, something like Dodd-Frank? After the mortgage meltdown, they came in with all these regulations. Do you think they'll ease up, or will they make it more stringent?
Under Trump, the CFPB really hasn't had too much in the way of enforcement. They've kind of laid back and let people do what they've done, and by the most part, banks have followed the rules. I think that with every other pressing issue out there, I don't see the new administration having high on their list coming after the banks to a stronger degree than they have been in the past.
Okay. So basically, it sounds like things have been kind of working fairly well the last so many years.
Okay. I think that's a fair assessment. I think things have been working. I think consumer complaints are down. I think banks are generally playing by the rules, at least, maybe not the biggest ones, but the rest of us are. And I think they're going to let people do that. And if there are complaints, they'll go after, direct companies that maybe aren't playing by the rules. But I think the rules themselves are going to stay pretty stable.
What do you think about foreclosures? Or do you think there'll be like a federal moratorium? This whole COVID thing kind of throws things into a monkey wrench in there.
Yeah, I do think that they will continue the moratoriums and the relief, and looking for ways to help people that have been negatively affected by the current economy and the COVID situation. I think foreclosures in general are going to be down because equity is up to such a degree. We have the highest percentage of equity in many decades here in America. So for a lot of people,
that still means though they have to have people pay their mortgages.
Sure, but people can sell. 10 years ago, people who couldn't pay their mortgage also didn't have equity, so they had foreclosed on. Now if you're sitting on a few $100,000 or even $1 million in equity, if you lose your job, it's really unfortunate. No one wants to be forced to move, but you can sell and cash out as part of that process.
Dane, I think wasn't the percentage something like 50% of the average American homeowner? That's how much equity they have currently in their home. There's some pretty high number like that. I
don't know the specific number off the top of my head, but it is one of the highest numbers we've had in generations.
Yeah.
So that actually to me, I'm just kind of thinking out loud here that it sounds like it would be really good for realtors, because as long as there's movement, people moving from one place to another, it almost doesn't matter where or how, just the fact that they're moving is good for the realtors, which also means it's good for you guys who are in the mortgage business.
Yeah, yes and no. It can be. It just sort of depends. The way this pandemic has sort of shaped the economy and the real estate market. We're seeing dynamics that we haven't really seen in the past. We're seeing a lot of fleeing from urban centers into suburbs, and so you have this wealth of inventory in San Francisco with somewhat declining values and prices. Meanwhile, here in the suburbs in Marin and the surrounding areas to the city centers, you're seeing a shortage of inventory.
Okay. So again, if you're a
I
realtor,
want to still stay a little bit close, but have a little more.
yeah. But if you're a realtor, no matter which side of the table you're on, you're going to get either more people selling who need a realtor or more people buying who need a realtor. Right?
Well, it's true. However, the problem is, finding the new house to move into before you sell your old house. So there's, they're not able to move people as quickly as they'd like to because of that shortage of inventory in the place where they're moving. They might be able to sell their house at a loss or whatever, but finding that new place to move into in the suburbs is becoming a little bit more of a challenge.
Which Pacific Private Money has actually had its best quarter last quarter, probably because of that, haven't they?
Yeah, I mean, just the second half of the year was our strongest 6 months that we've had. Certainly our strongest Q3 and Q4s we've ever had, largely because of the migration of people from like urban centers like San Francisco out to the outlying areas, and to Sonoma County, to Napa County, and to Marin, and same thing in Southern California. And we expect more of the same this, starting now. It's actually picked up this week after kind of a quiet last week and earlier this week. So we're seeing that migration continue. I think a big question will just be, will there be more sellers in the market this coming year than there were last year? People were holding tight because either they didn't need to move or they didn't want to because of the uncertainty. I wonder how many more, if there will be more inventory this coming year.
All right. Hey, guys, we're going to cut to our first commercial break. We're talking James Bond themes here. And when we come back, we have a couple of emails that seem to fit you guys. We want to, we'll ask the emails, and then we'll get back into other things that we were talking about before the show, which is, what do you think about what's going to happen with the economy and interest rates and that sort of thing. All right, our first trivia question on James Bond themes. Which English rock band who released an album entitled All You Need Is Now lent their vocals to the main theme of the James Bond movie, A View to a Kill? All right, that's our trivia question. Email or call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with my co-host, Mark Hanf is off, with Nam Fawn. I'm looking right at him, too. And our special guests, Dane Moeller and Kerry Ettinger. Our first trivia question on James Bond themes. Which English rock band who released an album entitled All You Need Is Now lent their vocals to the main theme of A View to a Kill? Kerry, the which band?
I believe that was Duran Duran.
It was Duran Duran. Very good. All right.
Someone sang it at the break.
Yeah, he did a good job.
Name names,
I'll tell you.
did a pretty good job.
I'm not going to do it again.
No, I didn't do it again because we're on the air.
That was a one-time performance.
You wanted to continue on about the inventory?
Yeah, no, we're just talking about the shortage of inventory in 2020, and which, coupled with the super low interest rates, created, and coupled with the demand from people wanting to buy homes in, more urban areas, suburban areas. It fueled a lot of the price appreciation, the shortage of inventory in Marin and Sonoma and Napa outlying areas. Would love to get everyone's opinion on, do you think there will be more inventory this year? And if so, why? Or will there be less? I mean, that's, be really curious to see. I have some ideas, but I would love to hear your thoughts, Dan and Kerry.
Yeah, I mean, it's there's a lot of dynamics at play, and it'll be interesting to know which side wins out, right? Is there going to be more sellers or more buyers throughout the year? Ultimately, I think that there'll be more transactions, but that inventory will remain pretty stable and pretty tight. Housing has become a much more important factor for people. They're listing it as one of the most important things that they can have in their life. And I think the demand for housing is continuing to increase. I think that people are going to be, there's more household formations going on. There's more people that can work from home. And so I think we'll have even stronger demand as rates stay low throughout the year. At the same time, I think that people have been kind of bailed out with forbearances. And I think those are going to come to a close. And I think we're going to see some more distressed sales, unfortunately. here this year. I think a lot of people have been dipping into their savings, making it work, hoping for things to turn around. But I'm really kind of pessimistic on an economic recovery, at least in the first half of this
year. And then what about those companies where, let's say, the vaccine comes in, and then they say, okay, time to come back into work. How many people are going to migrate back to the city?
I was reading an interesting story about investment banks in New York, and they've all kept a very tight grip on their employees. But throughout this, they've loosened up, and now a lot of people are moving to Florida and other places, and it's becoming kind of a perk. And it's going to be very hard for those companies to take that away because, Goldman Sachs across the street will let you work in Florida. And,
and the other thing is, though, they're also lowering the wages. Because they say, listen, if you're going to go to Florida, the price there is a lot cheaper than New York City, so we're not going to pay you as much.
And think about how much they save on desks and office space. And I don't think these companies are going to be looking at their bottom line and thinking, oh, we really need to have people here that we have to pay for to be here.
Unless they can see that the productivity is way down.
Sure.
And that'll counterbalance it. So I guess time will tell, because I don't think we've ever been in these times before.
Yeah, I think that if anything that this, the last, how many months is it now? 8, 10 months of this pandemic that we've been living under. The one thing it's definitely proved, or at least forced a lot of companies to figure out, is how to work remotely. And that's kind of been sort of an underground staff movement of a lot of companies for many years. Like, why do I physically need to come into an office anymore? I'm doing the same thing here that I might be doing elsewhere. Of course, different industries have different levels of collaboration, and of course, there's synergy and things like that. But to be able to provide people the flexibility to work from home, it's going to be hard for a lot of companies to kind of back away from that.
But then why is oil still around $50 a gallon then, or a barrel? I mean, $50 a barrel. Because
should we get into a conversation about the gas lobby?
Well, I was going to say, because the less people on airplanes, less people driving, in theory, right? I mean, we're in the Bay Area here, and traffic on the one good side has not been as bad as
right.
And so,
I know you'd think it would be supply and demand, right? The demand is low, so the supply is still the same. They need to lower the price, but the automotive industry has definitely been sort of operating under like a false premise of technology anyway, and it's only just now kind of starting to get an iota of reality when it comes to technology.
Because I don't think production's been cut, has it?
Of gasoline.
I'm saying, and so if they cut production, then you lower the supply, but they haven't. I don't think they've done that.
I think it's. I think that there's still a big rise in automobile usage in China and India and those areas of the world, and I think that is offsetting what we are here. And $50 a barrel. I mean, shoot, you talked to me about that 5 years ago. I would have said that's amazingly low.
Yeah,
right?
It was 150.
Yeah, right.
80 over 100. I mean, so we're not at 20. It hasn't gotten. We're not negative. Remember when we had that moment?
Remember that it was negative for like a day or something.
And I mean, really, those were just futures that were negative, but because they wanted to roll over the next coupon. But still, it's interesting that it hasn't gone lower. I agree with you.
I filled my swimming pool with oil. Now I'm going to be when I bought it at $2 a barrel. Now I'm going to sell it.
That's right. Yeah, it's cheaper to fill it with that.
You don't want to say that over the radio, because you're going to have a lot of people at your house come Armageddon.
Yeah, that's right. I just need to scoop the rainwater off the top, though.
Yeah, with Bitcoin
or the bottom
34,000 or whatever, there's a lot of things a little out of whack. Or 39,000 today, excuse me. So there's definitely some strange things going on in the economy.
Yeah. So Nam, we're going to go to your email question, and then next segment we'll go into one for Kerry and for Dane. Question comes in: do you think that the real estate market in 2021 will look to stay strong? You got about a minute to answer that question.
Yes. Done. Okay, cool.
Okay.
Move on to the next thing. No, I mean, gosh, we could cite so many articles, and I didn't print any for this because we covered so much of this in the last few segments, but, all indicators point to the real estate market being strong again in 2021, just because of some of what we already talked about. Low inventory still, interest rates are super low. The Bay Area economy, well, if we want to talk specifically about Northern California and Bay Area, the economy is still really strong. So, people still want to migrate or are migrating to the suburbs now. And so, we see this the same as we saw in the second half of 2020, which is just the activities really high. And later on, we'll cover a couple of deals of the week.
Yeah, I was going to say,
but
we're
bullish.
Week. Okay.
Yeah.
Very good. We'll come back. We got a good email question for our guest right up the mortgage alley. Second trivia question. Again, we're talking James Bond themes. As a change, the theme song for The Spy Who Loved Me, because ordinarily they'll have the name like Goldfinger. The name of the song is the same as the movie. This one was a little different. As a change, the theme song for The Spy Who Loved Me did not have the same name as the film. What was the title of the song sung by Carly Simon for the movie The Spy Who Loved Me? All right, that's our trivia question. Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Again, the theme song for The Spy Who Loved Me, the title of the song is not the same as the title for the actual James Bond film. What was the name of the song sung by Carly Simon? Don't touch that dial. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown, Nam Phan, Kerry Ettinger, and Dane Moeller here. Second trivia question: as a theme song, the theme for the song The Spy Who Loved Me. Okay, the movie The Spy Who Loved Me, James Bond. What was the name of the song that sung by Carly Simon? And the guys here didn't remember it. It was.
Wait, is it "Baby You're the Best"?
No, well, close. No, it's "Nobody Does It Better."
Oh, yeah.
But yeah, that's okay. But very good. All right. Email question comes in, and it's right up the alley for our guests here. So we're going to let them answer it. Best advice you can give right now for people looking for a mortgage? Because earlier we were talking about how, again, before the show started, what do you think interest rates are going to do with a new administration and all that fun stuff? So guys, take it away on that one.
Best advice, just give us a call, 415-870-2752. No.
Of course, we're going to get into that too. Yes, of course.
There you go. No, the best advice is to really talk to a mortgage professional and find out what the benefit would be for you to refinance. What you have now, it's an intricate analysis as to looking at what you have, what it would cost to get to a new loan, how you qualify. And really, if you can benefit, it's time to move, because the end of this rate dive, lowest rates ever, is upon us.
Okay, so you think that with the new administration, i.e. also with both state, Senate and House being the same as the presidency, that things are going to change?
Being Democratic, yeah.
Yeah, being Democratic.
Yeah, I mean, there's very little doubt that this administration is going to start spending some money, right? I mean, I think everybody can agree that they're going to be pushing through things, and that's probably beneficial for a country, but it's going to mean a lot more debt. And a lot more debt means higher interest rates, and that's for various different reasons. But by this summer, I'm seeing 3.5% being an average 30-year fix, but right now it's in the twos, for the best scenarios. So if you do have high threes, which we used to think was amazing, right? 3.75, 3.875. Oh my God, you're done forever.
Yeah.
Those kind of
people. In reality, it is amazing.
Yeah, sure is. But those kind of people can, in general, save a full percentage point refinancing now. And if you can do that and break even within 24 months, let's say, on the loan costs, and you plan on staying in the home, that's a win-win.
Yeah, and just to add to what Dane is saying, we tend to, as consumers, we tend to try to hold out for the best deal possible. But with something as fluid and dynamic as that's subject to market changes like interest rates and mortgages, it's really important to we try to really educate our borrowers to the point where, if you're meeting your goals with the way the loan is structured and the interest rates as they are now, especially with the uncertainty going forward, it's kind of time to act and take the rate that works and meets your goals, the low rate that works and meets your goals. The risk of kind of holding out and playing the market and trying to time things is, most of the time it bites you. Every now and then you'll get lucky, but the bird in the hand tends to be the safest way to go. Once you've met that goal with the refi, the numbers look like they're going to work out for you. pull the trigger because the fear or the risk of losing a good deal always outweighs the promise of trying to improve on the structure.
That's right.
Mm-hmm.
And what are you finding the best rates for a jumbo loan right now? 15 and 30 year?
30-year fixed, you're looking high twos, 275, 2.875, and 15-year fixed, not a huge difference, with the flattening yield curve and with what's going on in the market, you're not getting a big benefit like you used to of going to the 15-year. So those are only, 0.25% lower or so.
Okay. Do you guys do HELOCs too?
No, we're just a first trust deed lender.
Just regular first trustees. Okay. And
we have partners we work with to help our clients, but we don't write home equities.
Okay. And those 30-year, it's not due in 7. It's just a straight 30-year.
30-year fixed. The adjustable rate mortgages have really gone out of favor right now. And really, it's the right time to get it fixed. You get adjustable rates when you think you're at the high end of the rate cycle, and you're saying, okay, right now it's not that great, and I'm going to be able to refinance later. Or if you're going to be in the home for a short time period and you get a big benefit. Right now, with rates this low, it's time to get it fixed. And really, the adjustables are coming in at about the same. So it's not worth the risk. Even if you do sell, and maybe you'll turn your house into a rental. You never know.
Yeah, that's true. What kind of points and fees are associated with under 3%? 30%?
Yeah, so those are at 0 points. And for most of our clients, that is where we end up, is doing 0 points. And you have underwriting and processing and title and escrow and, kind of the standard things, but you're able to get into the 2s on jumbo and conforming 0 points for, the best qualified people.
Very good.
Wow.
And that's an important point, if I can just add real quick to that. A lot of my borrowers that I'm working with, a lot of my clients, they will say, it's not that they're not happy about the rates we're able to provide, but the question comes up, I'm seeing even lower rates being advertised. And that's very common. I get those too. Anytime, if you have an active mortgage or recently refied, which I did about 6-7 months ago, you start getting a lot of mailers. And they promise, well, at least they show very low interest rates, but there's 2 things that people have to keep in mind when they're looking at those and evaluating those. First off, they are usually if you look at the fine print, they usually come in with multiple points, 2-3 points sometimes. So that means, you get that great rate, but you're paying for it. So when you take that and extrapolate it up, cost or no points, I should say, that's where you get into the rates that are actually realistic. The other thing to keep in mind is those advertisers.
I remember seeing
exactly. I'm working with a borrower right now that we're getting him I think 2.75%, and his question was, why is the rate so high? And I almost choked when I asked him that question. I'm like, that is probably the lowest rate in history that you're able to get. Like right now, this is literally the lowest rate in history that for your scenario. So I had to kind of educate him, that those rates that you're seeing are A, based on the fact that there's multiple points associated with that interest rate, and then B, those advertisements are always based on the perfect scenario, the perfect borrower, the perfect loan amount, the perfect loan to value ratio. I kind of refer to it as the unicorn loan, and it rarely exists. So when you couple that unicorn situation with all the points, then you can see why those advertisements are.
An ad in the paper for a certain car, and they say, "Sorry, that car's already gone." Okay, hey guys,
exactly.
Get to cut to
our. Unfortunately, that they're still. It's to me, it's deceptive, but they can still do it. It's still allowed as long as
they give at least one person that thing, right? Okay, here's our third trivia question, and this one we're going to take the third caller because we're going to give away that $25 restaurant.com certificate. Aha. I've heard of that before. The band Aha sang the lyrics of the theme song for which Bond film? Call 888-912-1190. The third caller with the correct answer is going to win that $25 restaurant.com certificate. Stay with us. When we come back, Nam's got some excellent deals of the week to discuss. Don't touch that dial. We'll be right back. Welcome back to the Best of Investing. Edward Brown here along with Nam Pham, Kerry Ettinger, and Dane Moeller. Third trivia question. Aha, the band Aha sang the lyrics of the theme song for which Bond film? You guys can't remember? It's The Living Daylights.
Oh, really? I didn't know that was Aha.
Yeah, that was Aha.
That was a recent one, right?
All right. So hey, wait, before we get into you with the deals of the week, Kerry and Dane, how do people get a hold of you if they're interested in learning more about what kind of great interest rates are out there for refis?
Well, best way would be just a phone call. We're always here at the office, and no entering pressing numbers. You get a live person on the phone, and it's 415-870-2752, and you can ask for Kerry or ask for Dane.
Very good. Nom,
Where's your office?
We're in Marin County, downtown San Rafael, on 5th Street between A and B.
Ah,
Right
okay.
behind the Rafael
Great.
Theater.
Stone throw
Oh,
away.
nice.
So Nom, tell us a little bit about Pacific Private Money and deals of the week, if you would.
Yeah, so Pacific Private Money, we are an alternative lender, sometimes called hard money lender, non-QM, any number of different names you'll hear out there. But essentially, we're Plan B when Plan A, which is conventional financing, isn't an option. And oftentimes, it's often not an option for a lot of different reasons. I mean, in the past, it would have been more or less derogatory credit, somebody who just wasn't a good credit risk, so to speak. But today there's so many different scenarios that really where private money is a viable option, and it's usually short term. So at Pacific Private Money, we make a lot of short term, oftentimes bridge loans, and that are a bridge to conventional financing or permanent financing. And so if you have a scenario that calls for that, typically it's a realtor who's calling us, or a mortgage broker, because they have a scenario that they can't solve with either in time or with the long-term loan. So you can give us a call at 415-883-2150, and this deal of the week is one of the common bridge loans that we see, although the circumstances are a little bit different. But this is a scenario where the borrower had to buy a home before selling their departing residence. In this case, it wasn't necessarily planned like they wanted to move up or down. They were getting a divorce. So as part of the divorce, they needed to move out. And both parties agreed to move out of their home that they had both lived in. And we provided a bridge loan for their purchase, in this case, the husband, so he could secure the purchase of a Mill Valley home before selling their departing residence. And while their departing residence was on the market, it had not yet sold. So we provided a bridge loan for $1.6 million. They were able to close on the loan and on the purchase, and they'll pay us off probably in about 4 months when they sell their departing residence. And it shouldn't be a problem to sell. We saw the property in Mill Valley. We do our BPO and we look at the market conditions, and it's going to be a no-brainer sale. It should move quickly. But that's typically when we're stepping in as a lender to help with somebody in a situation like this. And actually last year, sadly, we saw a number of loans that we made to people who were getting divorced.
People shelter in place, cooped up.
Yeah. So that was unfortunately one of the negative impacts of COVID, is that we saw a higher number of borrowers coming to us going through a divorce. And we're happy to help. Obviously, their long-term solution really is conventional financing. So this person was referred to us by their mortgage broker, and the mortgage broker will provide the takeout loan. But we also have a number of people who need a bridge loan who own their home free and clear. We have a lot of older retirees who are downsizing, and they have, oftentimes 100% equity. They own their departing residence free and clear. They just need to free up some of that capital to buy their next home. They don't want to move twice. So we provide the capital. Oftentimes they're not taking out a mortgage to pay us off. They're just paying us off completely. Sometimes, though, they are taking out a mortgage for a small amount or a portion of the loan just so that they have cash.
And they can't get conventional financing to begin with because their income is too low, right?
Oftentimes it's fixed. Yeah, they're on a fixed income, and the bank's going to tell them, well, sell your departing residence first, and then we'll be able to provide a loan for part of it. But again, if you have any questions about about either borrowing from us or investing with us, give us a call at 415-883-2150, or go to our website, www.pacificprivatemoney.com.
Okay. I'd heard about potentially inflation might be lurking its evil head, with a new administration, and if they're just going to end up printing more money. Of course, they're probably going to raise taxes too, so that's one way to get income into the coffers. But you guys think inflation is lurking out there?
I do, but I think it's farther out than people are thinking. We really need the economy to start revving up before prices are going to go up, because that's what inflation is. And people often think, oh, printing money is inflation. Well, no, it's not. It's the price of goods increasing, and that's because demand outstrips supply. And so we need a lot of demand. And the reason why printing money does that is because it puts dollars in people's pockets. But right now, the savings rate in this country is the highest it's ever been in, 50, 60 years. People are putting those dollars in the bank because they're scared. And so, until that, changes, even with government spending, we won't see the inflation. I do think that interest rates, though, will rise based on, this debt production. And also, there's going to come a time when the Fed steps out from pushing down mortgage rates. And that's really why rates are so low. It's because the federal government is an active buyer of the securities that back mortgage rates.
Well, if they stop doing that, isn't that going to potentially tank the economy?
Well, that's why they're doing it. They're figuring, look, if we want people to spend money, let's make their house cheaper so they have extra money in their pocket, right? It's an indirect way of subsidizing, frankly, the wealthier half of America that owns their home. It's something that they're doing directly to increase spending, ultimately. But once they feel like they don't need to do that, they're going to have to right-size their balance sheet. And that means they're going to, stop being a buyer and start being a seller. And all of a sudden, rates, you're going to see them pretty quickly, back into those high threes, which is still great, but not where you have right now.
Yeah.
I wonder how that's
one thing you point.
Go ahead.
Oh, one thing you pointed out, Dane, is the savings rate being, high as it is because people aren't spending it on anything. I think that's going to give opportunities for first-time home buyers who maybe they were sheltering in place with mom and dad, accumulating some down payments. And when things turn, they're going to be, and if they can work remotely, they don't have to, be a homeowner in San Francisco or compete against that. They can be a homeowner in Bakersfield.
Well, they also save money on gas and other expenses on their car and all that. Absolutely.
So I think that will push home ownership demand or home buying demand high into the year. So.
All right, guys, we don't have a trivia question, but audience, stay with us. We're going to come back with some thoughts for the day and a few more comments, and then we'll close this bad boy out. So stay with us. The Best of Investing is going to be right back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my co-host, Nam Phan of Pacific Private Money, and our special guests, Kerry Ettinger and Dane Moeller of Primary Residential Mortgage. Nam, you said you told us off air that an event's coming up. When is that?
Yes. Yeah. So we at Pacific Private Money, we often hold information sessions. Prior to COVID, we were doing a roadshow throughout the Bay Area, and we had to stop, obviously, in Q1 of last year. So we've been doing sort of Zoom information sessions for people, and our next one is February 4th, which I believe is a Wednesday.
No, it's February 4th is a Thursday.
Oh, Thursday, excuse me. Yes, we moved it to from February 3rd, which is a Wednesday, to February 4th. It's going to be at 6 p.m. And for this information session, we're going to talk specifically about the North Star Capital Fund, which is our ground-up construction fund. It is a fund dedicated to providing loans to builders, infill builders, and developers. One of the segments of housing that has been underserved with capital. So we have way more loan demand than we have capital for the North Star Capital Fund, which is why we want to focus at least this in February on trying to generate some investor interest. So to register, just give us a call, 415-883-2150, or go to our website, www.pacificprivatemoney.com, and go under the events page, and you can register there.
And Dane and Kerry, what is your website if they wanted to go to, if the audience wants to check it out?
I believe it's www.prmisf.com. Is that correct, Dane?
Actually, primaryresidentialsf.com.
There you go. That's okay. You know what? Everyone will just find it. You guys are a wealth of information on that. We have just about a couple of minutes before we need to come to our great thoughts for the day. Any last words there, gentlemen? Just keep.
Yeah, I'll just quickly say, we closed out the year last week. It was a 3.5-day work week, and we closed 6 loans, 2 of them that we essentially got on Monday, and closed in 3.5 days. So that's why people come to private money. We're short term. We can respond quickly. Obviously, the rates are higher, significantly higher than the sub-3 you can get with a conventional loan, but we're there to solve typically what Mark Hunt likes to call transactional distress. Something came up at the last minute, typically with your conventional loan, and we're there to get the deal closed, and then you can immediately work on the refinance. So again, give us a call, 415-883-2150. Very
good. And your fund, Pacific Private Money Fund, is still paying about 7.5%, isn't it?
Yeah, 7.5%. We'll end the year, although December numbers we won't have until the end of this month, but we'll end the year right around 7.5%. So continuing that track record.
And the Southwest Fund, I believe that yield was 12.23%.
Wow, that's fantastic.
Doing very, very well. And the North Star Fund,
was, I think they did 15%.
Did they do that? Wow.
Yeah, and then the last one, the Pacific Freedom Fund, pays a fixed 7%. So
very good.
We'll
all good rates to invest in. All right, guys. Here's our thank you very much, Kerry Ettinger and Dane Moeller, for joining us on the Best of Investing. And here's our thoughts for the day. The dinner I was cooking for my family was going to be a surprise, but the fire trucks ruined it. I'll tell you. And start each day with a positive thought, like, I get to go back to bed in just 17 short hours. That's my work. That's my work right now. Listen, if you wake up without a toe tag on, that's a happy day, right? So here, we're out with 2020, in with 2021. It's going to be a good year. Yeah. We're gonna make it a good year. All right, gentlemen.
Absolutely.
Really appreciate you guys joining us. Again, give out your information one more time, Kerry and Dane.
Yeah, absolutely. Primary Residential Mortgage, 415-870-2752. Dane Moeller and Kerry Ettinger.
Very
good.
And
you can also find us at primaryresidentialsf.com.
There you go. All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.